Good morning, it's Jeffrey Christian. I'm going to talk about updating the precious metals markets. They've been pretty strong this morning. It's Tuesday, July 1st. It's about 11:52 in the morning here, just shy of noon in New York. Talk about precious metals, but I also want to talk a little bit about precious metals investors' knowledge base and approach to thinking. And we'll get into that, talking about some naive thoughts and also some misconceptions and just inaccurate ways of thinking about the world, which get in the way of investors being profitable. Gold prices are up. They were up about $46.60 a few minutes ago for the day at $3,354. This is for the August contract, which is the nearby active COMEX contract. The price actually got up as high as $3,378. So we're seeing interesting increases in really gold, silver, platinum, palladium, copper prices today for a variety of reasons. The price is holding up. You can see from the charts here that the $46 move is almost hard to see and hard to tell on the price chart because it's within the band of recent price moves. And we continue to think that the price, could come down as low as 3,200 over the next 6 to 8 weeks. But we're also expecting the price to go back up and try to test 3,500 in the near term with higher prices beyond August. You're seeing strong demand from investors, primarily for gold, based on a variety of economic and political issues. And that's going to continue. Silver prices, they're up 31.8 cents for the July contract, which was about $36.17, holding well above $36. The September contract, which is now the nearby active contract, was $36.32.5 today, and that was up 15 cents. So we're seeing relatively strong silver prices. The July COMEX open interest is now down to 34.7 million ounces. And the September COMEX open interest is now 648 million ounces, which I believe is probably greater than the July open interest was at the start of May. But September is 2 months away. So we're seeing silver prices hold up relatively well. You continue to hear about investors selling silver back to dealers, and you continue to hear about investors being disenchanted with the fact that for old silver coinage, 90% silver coinage, or for medallions that are not official coins, they're not getting as high of a price. With the medallions, they're getting much lower premia relative to spot prices, whatever the spot price is that the coin dealer actually says is spot. And with the old silver circulating coins, they're actually getting discounts because a lot of that stuff, so much has come into the market from people who had bought it in 2008 to 2011 and 12, and then later in 2021 to early 2022. So much of it's coming in that the dealers are selling it to refiners, which are offering a higher price to melt it down, refine it back into bullion, and sell the bullion. And that's going to continue, and that's keeping the silver prices a little bit lower and a little bit less dynamic to the upside, even though you're seeing relatively strong investment demand for silver. You've got this headwind of other investors selling, and that's continuing to be significant. Platinum prices have risen very sharply. They gotten up as high as $1,378 today. They got over $1,400 yesterday. They're trading around $1,349 now. And you can see here, the chart on the left is the platinum price since 2019. you could see that we did see that spike up in early 2021 when we were coming out of the COVID lockdown, and there was a surge of buying across everything, including automobiles and including platinum on the part of investors. And that took the price over $1,300 very briefly back then. Then the price fell back and it continued to trade in that $800, $900 base to, $1,050, $1,100 ceiling, that range. And I put that over the right hand chart, takes it back to the year 2000. So you can see that narrow range really has been in place since late 2014, early 2015. And it's very important. I'll talk about that in a second. But it's very important to understand that. So we've seen the price spike up, and you keep hearing people talk about how the platinum price has been very strong in the first half of this year. But look at these charts very carefully. The platinum price has been very strong in June. Between January and May, the platinum price continued to trade in that range. It's broken out of it in June, and it's gone up sharply. And I think that's very important when you start saying, well, is this the beginning of a big upward move? Or is this a short-term spike that you'll see the platinum price fall back down to levels below $1,200? Our view is probably the latter, because you're looking at the primary use of platinum and palladium and rhodium is auto catalysts, and the auto industry worldwide is using less platinum. There are fewer cars being sold in many parts of the world, Europe, the United States, North America, Japan, and an increased portion of those cars are battery electric vehicles, which don't use gasoline or diesel, and don't use platinum, palladium, rhodium to clean the exhausts of petroleum products. So you're seeing secular long-term changes, reducing the amount of PGMs being used in autos, as well as cyclical ones where people are buying fewer cars, partly because of economic and political uncertainties and anxieties. They're pulling back from buying new cars the same way they're pulling back from buying new homes. Now, you did see a surge in auto sales in the United States in March. That reflected people buying cars in anticipation that the prices of cars would rise extremely sharply once the tariffs on autos, auto parts, steel, aluminum, and other factors came into play. So you had a lot of advanced purchases in March, but if you look at April and May auto sales, it's been relatively weak, again, because people are sort of preparing for the idea of hostile economic conditions. I want to talk about investment demand, and I'm going to talk about it here, and then I'll show you another chart. CPM Group issued a buy recommendations for platinum 2001, 2002. And a lot of our clients bought platinum for several years thereafter. Other people were buying platinum too. And you saw that investment demand drive the prices of platinum from, it was trading between, say, $350 and $600 an ounce. And starting in 2002, it rose, and it rose sharply into 2007, by which time it was around $1,400 an ounce. Similar to where it got yesterday, right? And you saw a lot of investors buying a lot of physical platinum at that point. In early 2008, there was a power outage in South Africa, which severely disrupted the platinum group metals mining industry for a relatively short period of time. There were miners trapped underground who had to walk out because the electricity was out, and the industry was interrupted in its production to the point where the producers actually, at least some of the producers, declared force majeure on their rhodium shipments because they didn't have the power to refine it. It was relatively short-lived in the first quarter of 2008. By the time that was behind the market, and a lot of auto manufacturers and others raced in, they bought rhodium and drove the price up to $10,000. By the time that was behind the market, the auto industry was realizing that it was in a severe recession, which had begun in the second half of 2007. And so they sold off that rhodium and they sold off the platinum and palladium that they had bought in response to concerns that they wouldn't have enough metal to build cars when the South African power went out. And you saw platinum and palladium and rhodium prices fall. And platinum ultimately dropped as low as $800 over the course of 2008 during the Great Recession and the global financial crisis. It rose back in 2009, 10, and into 11, partly because of the sovereign debt crisis in Europe and partly because of the concerns over sharply increasing deficits and debt levels on the part of the U.S. government. And the U.S. government, two of the three credit agencies downgraded Treasury debt in August of 2011. Interestingly enough, there were people who had been waiting decades saying that the Treasury debt ultimately had to be have its credit rating reduced. When it happened, the world did not collapse. So by September, gold prices peaked. October platinum reached a peak around the same time. And then you started seeing some of those investors who had bought platinum between 2002 and 2007 selling. They sold physical platinum. Our estimate is somewhere between 3 and 5 million ounces that were sold 2012, 13 into 2014. 2014, there was a large strike in South Africa, about 6 months. And the price you could see here was pretty much moving sideways. It didn't rise. The largest platinum producer, kept announcing, I think there were 12 announcements over 6 months, where it said, we have enough platinum to meet not only our own clients' needs, but our competitors' clients' needs too. So there's no reason for investors to race out and drive the price back up to $2,000 or more the way they had in 2008. Investors listened and said, okay, so what happens when the strike ends? What happens is the price goes and it drops, from $1,400 back down to $800 an ounce. Now, investors had been selling late 2011 into 2014. But when the price fell below $1,400, they stopped selling their physical metal. Much of it was still ostensibly mark-to-market profit because they had bought it at prices between $600 and $1,400 in, a decade earlier. But they didn't want to sell it below $1,400. And we had clients, high net worth individuals, institutional investors, that were saying to us, we're going to wait till the price gets over $1,400 to see whether we should resume sales or if something strategic had changed and secular had changed, that it was the next upward move. So we're there again. We're at that $1,400 level. Our expectation is the price is going to fall back and that metal will not be coming into the market. But when they stopped selling, they were very much concerned about the price falling. So what they did, they hedged themselves on the NYMEX. And you can see here, prior to 2011, 2012, there were virtually no short positions. The blue stuff is the gross short positions held by non-commercial market participant, large non-commercial market participants in the NYMEX platinum contract. And you can see very little short selling. There was some in the 90s when CPM Group was recommending shorting platinum, But from 2000 onward, there's very little short position. Once you got into 2011, 12, 13, and those institutional investors and high net worth individuals said, we think the price is going to fall, so we're going to start selling. You started seeing an increase in gross shorts on the NYMEX as well. You also then, when the price fell below 1400, you saw a very sharp increase in those short positions. So they were holding on to their physical metal. They stopped selling physical metal, and they hedged their exposure to further price declines on their remaining inventories, holdings of platinum, with NYMEX short positions. They held those into about 2019. The price was bouncing around $800, $900 an ounce. They said, we think that, we don't have to keep those short positions on, and they liquidated their shorts between 2019 and 2020. Then beginning around 2021, 2022, you saw new investors building short positions on the NYMEX. And right now you have very large short positions held by investors on the NYMEX. If they decide that the price is going to continue to rise, they probably would liquidate those short positions. But if they think the price is going to fall back, they're going to keep those short positions on. So we'll be watching this to see what the sentiment is of institutional investors and other people who have large positions. Now, pay attention to the upside too. You had a big increase in long positions, the gold part, and in net long positions in that period, say 2005 to 2007, 2010, 2011, and it stayed high. It came off some in that period, 2015 to 2019, 2020, but it's risen again to near record levels. It's not as high as it was at certain points over the past 20 years, but it has gotten very high, 3 million ounces of open interest roughly on the gross long side. So you're seeing a lot of institutional investors and others that trade large positions on futures being involved in platinum, really over the last couple of years, but it's become prominent, and it's probably the driving force in the sharp increase in platinum prices that we saw in June, not in the first half of the year, but in June. July is an active 9-month NYMEX delivery month. We're going to have to see what happens going forward after July. Palladium prices also have risen, partly in collaboration or cooperation with platinum. Palladium is used in the auto industry, and there were people who were touting the idea that the auto demand for PGMs would rise sharply over the near term because we weren't going into a recession and people would start buying cars again. But again, here you can see really palladium has been traded in this narrow range 2024 through the first half of 2025. And while on a short-term basis, you get the spike up similar to what you saw in October of last year, in a longer-term basis, the palladium price is still trading in that sideways channel. I want to switch gears a little bit and say things that'll probably irritate some people, but maybe they need to be irritated and maybe they need to think a little bit better. I want to talk about the difference between knowledge and naivete. And naivete is the quality of being naive. It's a lack of experience, wisdom, or judgment. Don't take my word for it. That's the Oxford Dictionary's definition of it. I want to talk a little bit about an example of political knowledge. Political scientists have a rubric, which is that wars that threaten the existence of a regime, a nation, or a culture are always fought at the best available military technology possessed by each side, and that the possession of military technology may be significantly asymmetrical between the two adversaries. And you see that throughout history. You know, got a nuclear bomb. If I am at war in Afghanistan in 1979 through 1989, or in Ukraine in 2022, 2025, I might not use that nuclear weapon. But if that war comes to threaten my existence as the leader, or my nation, or my culture, I may use that. The flip side is the other end of the spectrum. I'm a poor country. I don't have a lot of military hardware. I don't spend as much money on military as the United States or even NATO or Russia or China. But I'm at war. I don't have a nuclear weapon. I have improvised roadside explosive devices. I'll use those. I have people who will give their life for our nation, and they'll risk approaching soldiers and slitting their throats. I'll use them. So wars are fought if they are critical to the existence, or perceived as being critical to the existence of a regime, a nation, or a culture. They're fought at the best available. You're going to use what you've got. That's all it means. That's knowledge. It's common and it's fair. Now, here's some examples of political naivete. I heard this, I've been hearing this on the news. Oh, we have to see if Iran is going to respond. Yeah, it's going to respond. You have to be extremely naive to think that Iran would not respond. I've also heard that, Iran's nuclear development program has been obliterated and will be years to be rebuilt if they even bother to rebuild it. And we've seen in the last few days new intelligence coming out of Iran that they had in fact moved a lot of their equipment and most of their enriched uranium away from those three prominent sites that the Israelis and the United States knew about, and they put it in dispersed locations throughout Iran, and they've restarted their program already. And you would have had to be naive to expect them to stop that program or not restart it. Another thing that's really naive is that nuclear bombs can only be delivered by missiles. Yeah. And you've heard this with the U.S. government. The administration has said, we're taking steps to protect our military bases overseas and our military and government establishments in the United States. They haven't said anything about protecting civilian soft targets. I can look out my window and see what is now the Freedom Tower. I used to be 4 blocks from the World Trade Center. I watched it. I felt the heat. I watched the buildings collapse. I watched the planes fly into the buildings. I watched people jumping to their death. And after that, the police and the U.S. government had meetings for people who owned businesses in Lower Manhattan. And they talked about the various ways that the next terrorism assault will be. No idea who, no idea when. We had one in 1993. We had one in 1913. There'll be another. And there are different ways that it could be. It could be chemical. It could be nuclear. It could be a dirty bomb. It could be, gunmen shooting up the place. You just don't know. But nuclear bombs can be delivered in the trunk of a car. And you've got to be naive if you don't realize that. And you have to be naive if you don't think that Iran will fight using its best available technology. Now, that's political naivete, and you might say, how does that affect gold? In which case, you probably should retain CPM Group to help you understand the role of gold in preserving private wealth as well as government wealth. Here's another example of market naivete. Ask yourself these questions. How many times does your worldview of silver and gold and other things and the way the world works need to be proven inaccurate by events, by empirical evidence? Wow, that just happened. Before you begin to think that your beliefs just may be wrong. How many times does the dollar need to not collapse? Oh, it's fallen 11% since January. It's gotten as low as it was last March. It's still up sharply from previous years. You're seeing a lot of money coming out of the dollars, going into investments in Europe and Japan and other countries, which weakens the dollar and boosts those currencies, exchange rates. That's a cyclical factor, given the fact that the U.S. stock market and U.S. economy have outperformed those other economies for many years, and we've seen this tremendous flow of money into the United States from overseas investors, most of which is staying in the United States. But some of it is coming out because, hey, Europe is not quite as bad off economically as we thought. And relative to the United States, which is looking worse than we thought, maybe I should be doing some investing in Southeast Asia or Europe or Japan or Australia or other places. So the dollar hasn't collapsed. And the dollar's death has been foretold many times over the last 50 years. But it's still 58% of monetary reserves, and it's still something like 70 or 80% of private sector financial wealth. How many times do the BRIC nations have to not mention gold or a BRICS currency before you start thinking that the people who are telling you that the BRICS are going to come out with a gold-backed currency maybe aren't telling you the truth? How many times does a large open interest level on the COMEX silver or gold contract not lead to a collapse of the COMEX? Or what they call a default. By the way, the LBMA cannot default because it's a trade association. An individual bank or two in London could default, but they probably won't default over gold. If you go back to the last time any banks in Europe defaulted, it was 2008 and 2007, and it had to do with derivatives, credit default swaps, and collateralized mortgage obligations, not gold. How many times does a large delivery of silver or gold depository receipts not lead to a massive reduction in gold and silver deposits on the COMEX? You saw, 82 million ounces of silver depository receipts change hands a couple months ago. And meanwhile, the amount of silver held in COMEX depositories rose to record levels. They weren't taking that silver out. They were changing ownership. How many decades need to pass without silver mine production plunging before you realize that the world's not running out of mineable silver? At what point do you consider recalibrating your beliefs? I was talking to a client last night in the Asian time zone, and we were talking about our CPM Group's projections for economic activity because it's central to our short and long-term outlook for metals prices. And I was saying, we have a meeting every morning, and those meetings have become extended in length because we are going through our expectations of the economy, the financial markets, the dollar, the stock market, gold, silver, platinum, palladium, other issues every day. We are constantly recalibrating our thinking. We try to avoid beliefs. We try to analyze. We try to base our analyses on knowledge. and we try not to be naive about stuff. Speaking of market naivete, there is a meme going around by gold and silver promoters right now that the Chinese government is setting up a network of gold depositories around the world that would hold Chinese government-owned gold in custodial accounts, so not under their control, that would back RMB, internationally traded Chinese yuan, held by non-Chinese entities. And that they were doing this because they wanted people to hold gold-backed RMB rather than the US dollar as a way of holding their wealth. As I said, 70-80% of world wealth is denominated in dollars right now, private sector wealth. Okay, there are several inconsistencies in this concept. First, there's an enormous lack of internationally traded yuan to cover international trade and investment flows. It's somewhat less than 10% of the float of currencies compared to the dollar, which is something like 80 or 90% of floating currencies. No, not quite that high, but it's very high. There's not enough RMB to really cover international trade and investment flows at this time. And to make it so there were enough would be hyperinflationary for the Chinese economy. Chinese government really doesn't want to do. Second, the Chinese government has a stated policy that our gold stays in China. It has no interest in exchanging its gold for RMB or other currencies held by foreigners. You want to hold your currencies? You want to hold our currencies? That's fine. We'll hold our gold. That actually is one of the reasons why you won't see a gold-backed BRICS currency. Chinese, Indian governments say, we're not going to use our gold for international trade purposes, even with our brothers in Russia or Brazil or South Africa. We're keeping our gold. Chinese government has no interest in putting up its gold and having those gold reserves drained by people coming back to them with offshore yuan. And finally, and most important, there's this internal inconsistency of the idea that an offshore gold-backed RMB, that an offshore RMB would need to be backed by gold in order to be attractive enough to compete with the US dollar. You know, if you have to back your currency with gold, that's prima facie evidence that there's a lack of interest or a lack of positive vibes toward your currency compared to the dollar. Yeah. So gotta stop and think through these things. A couple little comments. We dabble in analysis, political science. We don't dabble in partisan politics. If you've listened carefully to me, either in the last year or in the last 50 years, you'll find that I have a tremendous disdain for party politics. Party politics are probably one of the biggest threats to American democracy right now. And it's on both parties. I agree with Arnold Schwarzenegger. We should get rid of party politics. Yeah. So when I hear some troll say, oh, you shouldn't be talking trash about Mr. Trump's policies, understand, that's not partisan politics. That's political science based on numbers and facts and realities. It's political science based on independent, nonpartisan analyses of the $3 to $5 trillion of additional debt that will be added to the U.S. national debt on top of the debt that was going to grow anyway if his policies come to fruition and remain in place for 4 years. It's political science to look at the number of court rulings against him. It's not partisan politics. It's not anti-Trump. It's pro-democracy. And if you don't understand that, you could hire us to try to educate you, or you could go to the public library, or you could get off the internet and start reading newspapers and books and going to the community college. But if you're going to continue to think that any criticism of an incredibly incompetent and corrupt government on both sides of the aisle is partisan politics, you're going to miss a lot of stuff. And you're probably going to take that lack of knowledge of the political environment and use it against your own best interests in your investments. Because if you think that politics don't matter to gold and silver, we're at square one in your education about gold and silver. That's all I have right now. I'll talk to you later in the week. Take care of yourself. Take care of those around you. Try to do something good for the world, because there's a lot of bad things that are being done for the world right now. Take care.